Well, good morning, everyone, and thanks again for rejoining us for this very important financial reporting update for June 2020. Of course, this session, we ran a little bit over time last week, so apologies for that, but this session is really geared towards our not-for-profit clients, such an integral part of our client base. And as Hayley will describe to you this morning, there are some nuances regarding the accounting standards that will apply for not-for-profits either for the first time or with respect to the government stimulus as well, that will be also applicable to not-for-profits as opposed to for-profit entities. So thanks again for joining us. Hopefully there'll be plenty of questions like last time. I think that everyone's contributions to questions last time might have led to the session running over last time, but certainly on behalf of everyone at PKF, thank you very much for rejoining us this morning. And without further ado, I might perhaps throw over to Hayley to kick us off for this not-for-profit session. Thanks, Hayley.
Thanks for that, Marty, and thank you everyone for coming back again. Yeah, so I think it's a bit of a blessing that we ran over on the last session last week, because I now get an hour to take you through the not-for-profit particular areas of accounting. And in saying that, I'm also going to encourage questions to come through. I like a good challenge in answering questions live, so please bring them through. I'll stop at particular areas at particular points throughout the session to answer questions. But we do have a nice long hour to go for, which is great. We might even finish up early if everything goes smoothly. So today, what I'm going to take you through is, I'm just going to give you a bit of an overview as to why we have a not-for-profit specific session and why we've got this accounting framework which differs from the rest of what the for-profits apply. So I'll just give you some background into that and some of the common differences that we have between for-profit and not-for-profit. I'll also go through revenue and income, because that's a new area for the not-for-profits this year. And the standards are quite different between the for-profit and not-for-profit. Then I'll go through the COVID-19 impacts. And finally, finishing up with some changes that are occurring if you have previously prepared reduced disclosure financials. You'll need to transition over to the simplified disclosure financials going forward. Right. So first of all, who is a not-for-profit entity? The AASB has been busy working on a definition of not-for-profits, actually, and this is what they've come up with. They define a not-for-profit entity as one whose principal objective is not the generation of profit. A not-for-profit entity can be a single entity or a group of entities comprising the parent entity and each of the entities that it controls. So the main part there is that the objective, the principal objective, is not the generation of profit. So if your not-for-profit meets this definition, then what it means is that you can apply the not-for-profit suite of standards. I'll say that though with a bit of caveat, you do need to have a think about who you're reporting to, because there are some instances where not-for-profit entities need to apply international accounting standards. And if you are applying international accounting standards, you can't be applying Australian not-for-profit standards, unfortunately. So that's the main difference between for-profit and not-for-profit accounting. For-profit is based on our international or our IFRS international accounting standards, whereas our not-for-profit accounting is Australia specific. So the Australian Accounting Standards Board, they're the ones who are responsible for setting the not-for-profit accounting standards or differences. Now, as the definition there explains, it can be, not-for-profit can be a single entity or a group of entities. So therefore, not-for-profits can have to deal with the burden of doing consolidated accounting if they're seen to be controlling another entity. So yes to that question. Next of all, can we have mixed consolidations? So this is a tricky one, and yes, it can occur. So if I've got a not-for-profit who's the parent entity controlling a for-profit entity, we then have differences in accounting standards, which can be quite tricky to deal with. I'll talk to that more on the next slide. And then finally, how do we determine the accounting policies? So if you're a not-for-profit entity, if you're meeting that definition there, you need to work out whether, first of all, you have to comply with international accounting standards, in which case you can't use the not-for-profit ones, or if there's no requirement there for international accounting standards, you may choose then to elect to go down the not-for-profit Australian specific policies. Where you get these policies from, it's all on the Australian Accounting Standards Board website. And actually, interestingly enough, I read the standards a lot, and as you go through the list on the website, they start with AASB 1, which is a for-profit one. And as you get further down towards the end of the list, you get ones that have got 4 digits in them, such as AASB 1060, which is one of the new ones that have come out lately. If you're reading a standard that has 4 digits in it, you know it's been created by the Australian Accounting Standards Board, which means that it is going to be for the not-for-profits. If you're applying any of those standards, it means you can't apply international accounting standards. All right, so not-for-profits and consolidation. I thought I'd add this little piece in. I wasn't going to touch on this at last week's presentation, but given I've got the extra time, I thought it'd be nice to take you through it. We need to do a consolidated account, a set of accounts where the parent entity controls another entity. So in the standard, they use the word of investor and investee, but I'll try and just use parent entity and subsidiary. But control generally occurs where these 3 conditions are met. So the first one is that the parent entity has power over the subsidiary entity. So they've got to have the actual power there, be able to control it. They need to be exposed to the returns from the entity. So that whether they're profitable or whether like they're positive or negative, they just need to be exposed to that kind of variable return from the subsidiary. And the third condition is it's great to have the power, but they've got to be able to actually use that power to affect the returns. So if those 3 conditions are met, then we have to apply consolidated financial reporting. But the interesting part for not-for-profits is that returns are not necessarily returns in dividends or financial kind of returns. So if you dig around in the standard a little bit more, there's an appendix that's been put in there by the Australian Accounting Standards Board just to help not-for-profits navigate it. And what it says is that the definition of returns, it can be positive and negative. So like I said, if you're making a loss, it could be a negative return as well. But the returns are broadly defined, and it also includes financial and non-financial areas. And the third point there I think is really interesting, that a return could be direct and indirect benefits, such as the achievement or furtherance of objectives. So if you go back to what that not-for-profit definition was earlier, it said that you had to have objectives that aren't generation of profit. But then if you take this definition here, if your subsidiary is trying to further that objective, then you could end up under consolidated accounting. Interestingly enough, the ACNC found it really complicated to try and apply this accounting in some instances. So therefore, the ACNC doesn't require consolidation if it's impractical to do so. Because if we're sitting with companies that are limited by guarantee, we're not owning shares in another company and we're not getting dividends. However, by applying these rules and this logic, you could find yourself in a situation where you are controlling an entity even though you don't have shares in it. And the breadth of that kind of control could be really varied, like could be really wide. So I like to use I don't want to pick on them, but I like to use the example of churches, for instance. So we might have like a top figurehead that's kind of organising all of the church activities, and then you've got all your individual ones as well. So if we look at this definition that's here on this screen now, we might end up in a situation where all the churches have to consolidate, which could get quite complicated. And it could change through all the churches and religions as well. So the ACNC is just put in there, if it's impractical to do so, don't consolidate, but include a note to say why it's impractical to do so. All right, so I've just had a few questions come in, which I'll answer now. So just give me a sec to read through them. What is the correct accounting treatment when a charity has given commercial and residential tenants rental concessions during COVID-19 period? We just use the cash received or show the revenue at 100% of the agreed rental with a debit in profit and loss for the concession given. So with the rent concessions from the from the lessor side, there's no changes to the accounting. So what we need to do is, if you've given that concession, you just reduce the income and you straight line the remaining amount of the income. So unfortunately, no concessions there as a lessor, no concessions because you're not for profit either. The rules are the same for the for-profit and the not-for-profit for rent concessions on the lessor side relating to COVID-19. So hopefully that answered that question. I've got another question that's come through. Why did the ACNC not look into using international public sector accounting standards like we do in New Zealand? It's a good question, and it's a difficult one to answer. I guess it's probably an answer for the ACNC to do, or more so the AASB. I will direct you to a publication, and I'll send this out. Actually, it's very interesting. The AASB has recently done a document that explains why we're doing our own standards in Australia. So it's trying to explain why we didn't use the international public sector accounting standards, why we didn't use some other kind of framework, and why we're creating our Australian unique not-for-profit framework. So it's definitely the AASB who set that, and that's been done under their ability, under the FRC as well. And the ACNC is just following what the AASB is prescribing as being the framework. So that'll be the area that you start with to try and understand why. But that publication, which I'll provide, will hopefully give you that answer. All right, so a couple of good questions to start off with. Moving on. So that's not-for-profits and consolidation. I mentioned earlier that we can have mixed consolidations. So we've got these differing kind of frameworks where we've got our for-profits that use the international accounting standards, and then we've got our not-for-profits that use our own unique framework for not-for-profit accounting. So in scenario one, I've just done a quick org chart where we've got a not-for-profit parent, and then we've got a for-profit subsidiary. So in this instance, what we would need to do is, if we're preparing the financial report for the for-profit subsidiary as a single entity, we would need to apply only the accounting standards that relate to international accounting standards or for-profits. So that's any accounting standard that's got 1 digit or 3 digits in it only. We would not be able to venture into the 4-digit accounting standards or anything that's got a paragraph that starts with AUS. So it's definitely its own kind of framework. Then we move up to the not-for-profit parent. If they're requiring to do the consolidated financial report, so they're not using that exemption that comes from ACNC, and they're consolidating that for-profit up, what we need to do is use the for-profit accounting standards. So use that framework, and we'd have to adjust that for-profit subsidiary to reflect the not-for-profit accounting standards. Now, this isn't as difficult as what it looks, because when the AASB sets the not-for-profit accounting standards, they always start with the base of the for-profit standards, and then everything else is kind of attached in there as guidance or additional information. So going from a for-profit framework to a not-for-profit framework is a lot easier. However, on the next scenario, where we've got the for-profit parent and then we've got a not-for-profit subsidiary, it would be a lot more difficult. So in this instance, the not-for-profit subsidiary will use the not-for-profit accounting standards. But then when we move up to the for-profit parent, we would need to harmonise those accounting standards to take out all of those accounting standards that had the 4 digits in it, or all of the paragraphs that start with AUS. There's a lot of work involved in that. And I'll just go over the slide now to explain some of the differences. So the first one is impairment testing. Not-for-profits get a great concession where they're allowed to use different valuations for impairment testing. These aren't available to for-profit entities. So if I go back to this scenario here, I've got my not-for-profit subsidiary who is doing an impairment test, and their assets may not be impaired because they've got these more favourable rules for what the recoverable amount is. But then when we need to consolidate up to the for-profit parent, we need to then go redo that impairment assessment using only the valuation techniques that are allowed under the for-profit framework. So we may have an asset that's then impaired on a consolidated basis, but then isn't on the not-for-profit single entity basis. So that's where all the hard work comes into these kind of mixed scenarios for consolidations. Other areas of fair value. So fair value techniques, they take the same kind of approach as what the impairment testing does. So if you're a not-for-profit, it's a lot more favourable about how you do your fair values, about how you arrive at that, than what it is for a for-profit. The reason being is that in the for-profits, when we do fair value calculations, we take the assumption that all the transactions are on a commercial basis. and that there's going to be a commercial cash flow generator from that asset. But then when you get into not-for-profit land, generally we're not getting cash flows, or if we are getting cash flows from the use of asset, they're not commercial, because our basis of why the not-for-profit is actually operating is not a commercial basis. It's something that's other than for-profit. So that's why those concessions exist, to take into account the benefit, the community benefit, or what it would cost to replace an asset should we need that to continue our objectives. Like I said before, the consolidation is quite different, particularly if we've got those different frameworks. It's very tricky to work through. And then finally, income and government grants is different between for-profit and not-for-profit. It's particularly different this year because we've got a new standard that relates only to our not-for-profits. It's AASB 1058, income from all not-for-profit entities. And it's vastly different to what AASB 120's got, or what AASB 15's got. So that's something that's really interesting for this year, something to get your head around going forward. We haven't really been in this area before. Like, we've had small differences previously between for-profit and not-for-profit, but this is the first time where it's been quite a big difference, and something that you really need to understand. This list is not exhaustive. There's many other areas where there's differences between not-for-profit and for-profit. Unfortunately, it's not easy to navigate. So I gave a few tips. You can look for those accounting standards that have got the 4 digits in it. But really, to make sure you're getting all of those not-for-profit ones, you've got to look for the actual paragraphs which are in the accounting standards that have got AUS at the start. So hopefully they'll start to clear that up a bit and make it a bit easier going forward. But at the moment, that's how the standards are structured and how it works. All right, so I haven't had any more questions come in. Please feel free to keep plugging them away as they go. Like I said, I do like a challenge of trying to answer things on the fly. But getting now into revenue. So this is new, what we should be applying this year in the not-for-profit sector. So AASB 15, it does apply to not-for-profits. And that's an international standard. So that's something that we have in common with the for-profits. So it'll only relate, however, where we can fit within the scope of it. So that scope means that we have to have a contract with a customer. Now, AASB 15, when it was written, it definitely relies upon commerciality of a contract. So we talk about performance obligations. So whenever you're getting revenue under AASB 15, you've got to do something in return for it. However, that's not always practical for not-for-profits, because there are instances where the government may be granting you money without an expectation of anything being returned, or without some kind of specific performance obligation that you need to satisfy. And because of that, that's why the AASB created AASB 1058, which is income for not-for-profits. So this is an Australian-only standard. As I mentioned before, if you're applying this, you can't be applying international, you can't claim compliance with IFRS or international accounting standards. But it can only be used where AASB 15 doesn't fit, pretty much. So those areas are things like donations, because you receive that money without having to do any kind of performance obligation, bequests, in-kind arrangements where we don't have consideration that's linked to it, and then also some grants and funding. Now, there is a table here. I'm not going to read through it all right now. This will get handed out to you. And I got this table from a lovely publication that came from the AASB about how to apply the new accounting standards. So it'll just take you through this flowchart as to whether you're going to be applying AASB 15 or whether you're going to be applying AASB 1058. Now, I'm using this a lot. In particular, the area where it talks about sufficiently specific performance obligations. It's only one box that's in this flowchart that says, does the contract include sufficiently specific performance obligations? But that's very difficult to answer. So in that instance, it's a good idea to go back to the standard. There's an appendix in there called Appendix F, and it takes you through some scenarios where things can be specific performance obligations. So work through that, and if you get through Appendix F and you have the sufficiently specific performance obligations, that's when you go back to AASB 15, and if you don't, you end up here in 1058. So at the end of the day, what's the difference? Well, AASB 1058 allows you to recognise your revenue up front So as soon as you've got the entitlement to that income and you know that the cash is coming in, that's when you recognise your revenue under AASB 1058. So if you've got some large grants and the like, and like research grants, and you might be getting money over a period of time, but you've satisfied all the conditions at the start, then you would recognise all your revenue at the start, as opposed to recognising it as it comes in or as you perform activities. If you are under AASB 15, you'll only recognise that revenue as you are satisfying the performance obligations. So it's not based on when the payments come into your bank account. It's not based on when the grant starts. It's about when you're actually doing that performance obligation, which is why it's important to make sure that that performance obligation is sufficiently specific that you can measure against, because otherwise you never know how you're going to recognise your revenue. So vastly different outcomes. So one of them's got the income right up front, whereas the other one's got the income over time as you're doing some work and the like. So it's interesting. Definitely use this chart. Refer to Appendix F in AASB 1058. And also after this, when the slides go out, I will be sending out the AASB's publication which contains this flowchart about how to account for revenue under the new standards. Okay, so some key points for revenue recognition that are specific for not-for-profits as well. If something is received at a lesser amount than fair value, then you need to consider whether the contract's actually enforceable and whether sufficiently specific performance obligations exist. Because if you don't meet those two criteria, then you're going to be knocked out of AASB 15 and you're going to be back in 1058. I probably spoke to these points just before on the last slide about Appendix F of AASB 15, and it's also in 1058, which talks about where we're going to end up in 15 on 1058. So this is a lot of the challenges that I'm seeing right now. I've got clients that just don't know how to identify their performance obligations. And then when I get in there and do the assessment, I actually kind of might find that they don't have performance obligations. So we might be under 1058. So do this assessment. Everyone should be doing a revenue assessment, whether you're not-for-profit or for-profit, to make sure you're complying with the standards. And luckily enough, the not-for-profits have got lots of literature that's available from the AASB to help you through. So I just had another question that's come through. It says, if you have a mix of contract types, can you elect to apply AASB 15 to all? So when you start doing your contracts, grouping them together for your assessment, you've got to make sure that all the terms and conditions are quite similar. So if you've got contracts where they've all got some kind of performance obligation, but they might be performed in different geographical areas, you might be able to group those together. But if your contract types vary, so if you've got a whole heap of grant agreements and some of them have got obligations that you need to deliver on, such as going out and visiting a number of patients every month, versus ones that don't, which is like, we'll give you this money towards the generation of a vaccine, but you don't have to deliver a vaccine unless you can actually find one. Those contracts need to be assessed differently because the outcomes are very different. Because one of them, you're going to go back and check how many patients you've actually seen to find out how much revenue you can recognise. Whereas the other one with the vaccine example, well, you can recognise that revenue up front because you've got no obligation to actually deliver a vaccine by a particular time. So it's not sufficiently specific to fall within AASB 15. So yeah, there's just some points here to have a think about from Appendix F as to whether contracts are enforceable or not, or whether performance obligations are sufficiently specific or not. I think I've spoken enough on this. You guys can come back and refer to it as you're doing your assessment. And like I said, I will get that other publication out to you. Okay, another income area to be wary of is whether we're in an agent relationship. So if we're doing our revenue assessment, we've gone back through that flowchart, we've found out that we have sufficiently specific performance obligations. For this example, we'll just say that we have to visit 100 patients for mental health outreach during COVID-19 for the next month. That might be our sufficiently specific performance obligation. We're under AASB 15. We need to now work out if we're acting as an agent or if we're acting as a principal. So there's a lot of allspicing that goes on in the not-for-profit land, which is where the government may give you a bunch of funds, which will then get split up to go out to other not-for-profit entities to perform the service. So we need to think about this in terms of principal or agent arrangements. So the difference is, I'll just tell you what the difference is up front before we go through an example, is that if you're an agent, you'll only recognise the net amount as the income. So if you've got grants coming in, grants going out, you'll net them off and you'll only recognise the commission if you get any. But in some instances, you don't get any, so you don't recognise any income and you don't recognise any expense. Whereas if you're the principal, then you'll recognise the income and you'll recognise the expense separately. So that increases your total revenue, increases your expenses, has no impact on the bottom line for the profit at the end of the day. This can be challenging when you're looking at things like reporting thresholds, or thresholds for when you need an audit versus when you need a review. Because if you're a principal, you're likely going to get into that kind of area where your revenue is inflated, whereas if you're an agent, you may escape some of those regulatory requirements. So it's important to get this right. So first of all, determining whether you're a principal or an agent, you need to determine the nature of the promise. So go through that process of identifying the promised goods or services. So like I said before, we're going to go out and we're going to see some patients about their mental health wellness during COVID-19. Then we have to assess who controls each of goods or services before it is transferred to the customer. So in running my business, I don't have the skills necessary to go out and do these assessments. So instead, I'm going to make contact with my local doctor's clinic to find someone who's able to do it. And I'm going to engage them to go out and do the actual visits. However, I'll do all of the organising and arranging from here in my office as to which clients they're going to see, and I'll do all the reporting back to the government. So in that instance, I'm going to sit there. I'm going to be an agent because I'm not actually doing the work. I'm not controlling that service of the delivery of the visits to the patients. I'm only controlling the arranging of it. So that will put me into the agent pot where I'll only recognise the net amount. And then the amount that comes in for me is the grant amount. And then the amount that goes out is the amount that I've agreed to pay for the doctors to go do the visits. And I'm only going to recognise the income as the net amount, the difference between it. That net amount just reflects what I'm doing in terms of arranging the patient visits. A good way to think about this, I like to call it the inventory risk. And I define that as the risk that the entity will receive a loss from arranging the sales of goods or services to a customer. So in my example, I've gone and engaged this doctor to go out and do these visits for me. Now, if they don't, if the customers aren't there when they arrive or the clients aren't there when they arrive, I still need to pay this doctor because I've already arranged that. So I've got that risk of that cost. So inventory risk is retained by myself. So I'm sitting in that agent arrangement. All right, I'm just going to check if I've had any more questions come in. I will get to the JobKeeper. And I do have some interesting information for it because I've been watching what the AASB has been doing lately with their meetings, and there's been some changes there. And just the next question, in a single contract with multiple services, can I be a principal for some and an agent for others? Yes, you can. That's a really good question. So I think I've come across a couple of examples with in the aged care area for home care packages and the like. So with home care packages, sometimes you may be an agent where you're arranging for things like lawn mowing for one of your clients, but then you may be a principal if you're going out and having a social visit. So that's one contract with the government. One portion is an agent, one portion isn't. So you'll do that based upon the performance obligations. And you're going to have to get some systems in place to start tracking this stuff so you make sure you can record it correctly. All right, so no more questions on agency that I can see. So I'll keep flicking forward. All right, so this is timely. I'm going to have a look at the JobKeeper now. So first of all, I just wanted to talk about ACNC reporting. If you do report to the ACNC, the deadlines were extended. So any entity with a reporting date between March and August will now have up until the end of August to lodge. So that what they say is that you can lodge your annual information statement now at the end of August. What that means is that your annual information statement usually has your financial statements accompanied with it. So therefore you get the extension on both of those. Now just jumping into the JobKeeper, so not-for-profits, you do need to refer to AASB 105A, income for not-for-profit entities. You can't apply AASB 15 as there are no sufficiently specific performance obligations, which I was talking about earlier. So the government's not asking you to go out and do anything and deliver anything back to them. They're just giving you money so that you can continue your business. So therefore, we're not in AASB 15 then, we're in AASB 105.8. No sufficiently specific performance obligations exist. So what we need to do is recognise our income when the eligibility criteria is met. So the eligibility criteria, as I spoke to last week, was that drop in revenue and having your employees be paid $1,500 per fortnight. Now, when I was talking to it last week, I was of the understanding that the only eligibility criteria was that the employees had to be employed at 1st of March. I've since heard from the AASB, because they've been looking at this issue themselves, is that they're considering that you need to keep your continuous employment of employees to be one of the eligibility criteria. So what that means for recognising the revenue then is that each time you get a payment from the government, you need to satisfy that eligibility criteria, that you have maintained that employment relationship with your staff, and therefore that is the point in which you can recognise your revenue. So I was incorrect last week where I said we'd be recognising it all up front. For everything up until the end of September. The AASB has now clarified that no, you'll be recognising it as you've satisfied that eligibility criteria for having each of your employees employed. Makes it a lot simpler because we don't have to estimate the amount of staff who are going to leave. And I guess we still need to recognise it as a receivable once you've met that eligibility criteria, and the cash might come in a little bit later. But it's generally the same as what the for-profits are doing now. So the for-profits are recognising as they're making the payments to the staff. Not-for-profits are recognising it as they've met that eligibility criteria of having the continuous employee. Main difference is not-for-profits, they must show it as income on their P&L, whereas the for-profits can net it off against the expense. So that's the main difference we're looking at. Hopefully that clarifies it. I just quickly read this question again. It says, we have triggered JobKeeper and it has been raised as to whether we should actually estimate and include the full potential entitlement that will be received out to September in our 30 June account. So hopefully that clears it up. Don't do the estimate. Recognise the JobKeeper income as you've satisfied that continuous employment criteria. So it's not just the criteria of triggering the JobKeeper or having the employees at March. You've got the continuous eligibility criteria of keeping the staff employed. I'll do a bit of an email around to everyone who was there last week as well, so for those that couldn't make this session, just so that they're aware of what the correct treatment is for that. In addition to that, because the AASB have been talking about this, there's going to be a publication that comes out from them just to help the not-for-profits apply the accounting standard to the JobKeeper and other stimulus that's coming through. Now, I had some questions come through. I haven't done up a slide for it. I've only just recalled it now, about other stimulus that is available. So there's the cash flow boost that comes through. Now, the cash flow boost is calculated based on PAYG withholding from staff wages. However, that's just the way in which they measure how much to pay. It is not a reduction of any kind of employment tax or anything like that. So that cash boost payment is coming through straight as income, and it will be recorded under AASB 105.8, which means that as soon as you met that eligibility criteria, or pretty much when the payments were made, you could recognise your income then. The other type of stimulus that is common, now these are all different between states as well, it's payroll tax concessions. So if you have received a payroll tax concession, it means you don't have to pay your payroll tax. So you are reducing the expense for that one. So you won't have that one as an income, but you have a reduction of the payroll tax. So that doesn't come under 105A, it just comes under plain expenses to say you don't have that cost of that expense anymore. So hopefully that clears that up. Okay, no more questions that have come through. All right, I'll move on then. So other financial reporting areas for not-for-profits, having a really big time at the moment with changes. So we have a new standard that's come out called AASB 106, so General Purpose Financial Statements, Simplified Disclosures for For-Profit and Not-for-Profit Tier 2 entities. So with all of the hype about special purpose financial statements being removed, we thought that the not-for-profits were immune to that because it only related to the for-profits, but then this little piece came through which does affect the not-for-profits. So this is our new standard, which will replace the old RDR standard. It is mandatory from 1 July 2021, whether you're for-profit or not-for-profit. However, early adoption is allowed. So if you like the look of the new SDS disclosures, you can choose to do that this year. If you don't have the systems in place, you can take your time right up until 1 July 2021, but at that point you must move over. There's no changes in how we measure numbers. It's only changes in what we're disclosing. However, you may need to start gathering information for disclosures such as related parties and tax information. The great thing about this standard is it is one standard only. So for those of you who used the RDR previously, you would have seen that it went through all of the standards, and the disclosures that were shaded out in grey meant that if you were doing RDR, you didn't have to apply that paragraph. So there was lots of reading to be done. You had to go through the whole suite of accounting standards to work out what your disclosures were that you need to apply. But this new standard, it's all in one place. It means more work for the AASB, because every time there's a change in accounting standards, it means they need to go update this particular one to make sure the disclosure is reflected correctly in that. Now the SDS does have less disclosures than RDR. There are a few that are a bit more. I've got a publication I will send out to you that goes through them in detail. Now, how we got the SDS, it was based upon IFRS for SMEs, which is an international accounting standard. So across the world, a lot of people apply this IFRS for SMEs to do some reduced disclosure. However, the difference in Australia is that we apply full recognition and measurement, which means the numbers that we apply under accounting standards are the same, whether they're, I'm going to say this, but it's a bit contradictory, but our recognition and measurement don't change based on the size of your business. So any number that we calculate as, revenue is not a good one, but say for provisioning will be the same under the smaller entities as it will be under the bigger entities. And we wanted to maintain that. But under IFRS for SMEs, it's different. They've got different recognition and measurement policies. So that's why we had to create our own AASB 1060 to fit the Australian unique not-for-profit and for-profit scheme. Okay, so what does it mean if you're preparing RDR? There's going to be reductions in the disclosures compared to the current RDR, which is great. Hopefully that won't be so burdensome when you go to prepare your financial report. There is an increase in disclosures compared to special purpose financial statements. In practice, most of what I see is not-for-profits prepare under RDR because they assess themselves as general purpose or reporting entities and then prepare the RDR accounts. However, it doesn't mean that you didn't have the ability to do special purpose financial statements. So there might be a few of you out there preparing special purpose. And when you need to move over to general purpose, you will have an increase in your disclosures. The particular areas that are having the increased disclosure are related party transactions, financial instruments and tax notes. The great thing about the new standard is there's an option not to present a statement of changes in equity under certain circumstances. So I don't know about you guys, but how many people actually read the statement of changes in equity? If there's nothing other than profit, because not-for-profits, you're not issuing shares. You're generally not issuing shares. You're generally not having any of those kind of equity movements that are occurring. So if your only movement on the statement change in equity is profit for the year, you can elect not to include that statement. So you can simplify your accounts and only have the income statement, the balance sheet, and then the cash flow statement. Nice and tidy. Now there are some additional disclosures that are not currently required. This is things like disclosing the amount that you've paid for your audit fees, so keeping your auditors honest, and also just including information about your legal registration and where you operate your operations from. So those kind of disclosures have been required in the for-profit accounts for some time, but it's just one small disclosure that will come up to say we're registered business as a company limited by guarantee in Australia, and that's where we conduct our businesses. That's the equivalent of what that disclosure will mean. So if you are one of those businesses that was a not-for-profit preparing special purpose financial statements, you can continue to do that. You're not required to change before 1 July 2021. But if you are doing that, you need to explain why you're considered not to be a reporting entity. There's some example disclosures that the AASB has put out for that, so you can just copy and paste them straight from there. You also have to disclose about consolidation. So if you're required to consolidate and you haven't, explain why. But then you can use that exemption from ACNC to say it was just impractical to consolidate, so that's why we have it. Okay, now I'll just come and see if there's any questions that are coming in. Okay, so back to the government stimulus. If the cash flow boost is based on the level of PAYG, if you triggered the first payment and received the first payments, do we need to include the next 4 installments from July to October at 30 June? I might request to take this one offline. Reason being, the cash flow boost is not a big amount, so I haven't put a lot of research into it. I've only really put it into the JobKeeper. But I am curious on this question as well. So David, if you don't mind, please give me your email address, or I'll find it afterwards, and I'll get in contact with you about that. And I'll also do a bit of a release when I send out the publications on what the answer is to that question. Okay, so that's all I had in terms of the not-for-profit update. We're going great for time here. So for the next 5 minutes, if anyone wants to pop up some questions, I'd be happy to answer them. Hopefully it was a nice thorough session. It wasn't as rushed as last week, and hopefully you got something out of it. But I'll just give you that 5 minutes to pop some questions up if you like. Okay, so I've got some more notes in there that the cash flow boost is quite a lot of money, so we will have to put some clarity on it. Like I said, yeah, I'm definitely happy to do that research and send out a notice on that. Also, if anyone's got questions, feel free to contact me. My details are there on the screen. While I might not have the answers directly, I'm happy to go out and do research. It's what I enjoy doing, and I can come back to you in a timely manner. Yes, and Peter's just mentioned that that's very confusing over here in Australia compared to what's in New Zealand. It is, and I'm afraid I'll probably not much help for New Zealand because it was an Australian specific kind of not-for-profit area. New Zealand's standards, they're nice and tidy because you always rely on international standards that come out. You don't have any kind of local standard setting occurring. So it does make it easier to use, but in saying that, I guess what we have here in Australia is a unique model for our not-for-profits. It's something to be proud of. Our standard setters are putting together some good tools there to help the not-for-profits get through it. And our recognition and measurement is something that's only here in Australia. I think that's something we can be proud of, that our recognition and measurement can be the same no matter the size of the business, big business, small business, we all apply the same recognition and measurement policies. Okay, so I've got another question. What is the current treatment of leases in the financial statement? So you do need to apply lease accounting. So AASB 16, it applies to for-profits and not-for-profits. So if you previously had an operating lease, a rental for something, let's say like a premises, building premises, and you do need to go through, calculate a right of use asset, and then calculate a lease liability that'll carry on your balance sheet. In terms of not-for-profits, there's a lot of peppercorns are about. So a peppercorn might exist where you pay $1 for a 99-year lease of something that's on Crown land, like a scout hall, for instance. What happened a couple of years ago with the introduction of this standard was the AASB tried to get the peppercorns recognised on the balance sheet at fair value. We ran into a lot of trouble though, because trying to fair value some of these properties was really difficult. Because if you look at like the scout hall, to say it's the sailing scouts and they're on the water, it could be really desirable land. But that fair value of that land, if you were to sell it for development, is a lot different to what the fair value would be to a scout hall that just wants to use it for continuing use. So in the background, the AASB has got a project going on where they're trying to get together some fair value guidance on valuing these kind of things. And the AASB intends to revisit peppercorns in the future. At the moment, we don't need to recognise peppercorns at fair value. We just recognise them at cost and include some disclosures about reliance on those leases. But it's not done and dusted yet. Just keep in mind the AASB will come back to try and fair value these peppercorns in the future. Okay, if we grant a license to use a trademark, what is the rule for determining whether it is recognised at a point in time or over time under AASB 15? That sounds like it might be a really specific kind of question there, Beth. I don't think it's one I can answer live, but I will come back to you on that one if that's okay. AASB 15 is interesting when it comes to licenses and the like. It's nothing different between for-profit and not-for-profit, but whenever you apply AASB 15, it's very unique because every contract's very different. So I can't really give broad answers on those kind of situations, but I will definitely get in contact with you. And Hazel's requested if the recordings will be available. Absolutely, they're going to be available. So we're going to work on that this afternoon. The guys in the office are going to get them all packaged up and sent out. So those who couldn't attend will get a copy to be able to review. And Peter, I will get in contact with you regarding a New Zealand session as well. Okay, so Hazel's just asked, if you have a lease that has a commercial terms but the landlord gives full rent relief each year, would you consider it a peppercorn? You'd need to have some kind of connection, I think, there. Yeah, it depends on the terms of the lease. If you can find that full rent relief is actually linked to that underlying asset, and maybe seeing that those terms and conditions are contained in the one lease. However, if they operate very separately, then you may not have a peppercorn. It really depends on the terms of the lease. If you have an example you want to bring to me, feel free to do so and we can have a look through it together. Okay. All right. So the questions seem to have slowed up now. If I haven't got to you, I haven't been checking the chat box, sorry, only the question box. If you still want to get in contact with me, like I said, my phone number, my email address is there. Please feel free to reach out. Okay, so Conrad's just stopped on asking about the JobKeeper again, because his internet dropped out. Gosh, I've had technical issues like that last week. So we're recognising the JobKeeper per payment. So as you satisfy that requirement for the continuous employment of your employees, as opposed to estimating the entire amount up front. So that's the essence of that. All right, guys. Well, I'm going to wrap it up. Thank you very much for coming. And like I said, reach out to me. We'll get the recordings, we'll get the slides, and those other publications I've spoken to out to you in the near future. And I hope to all see you at the next event. So thank you very much, everyone.